Hey everyone, welcome back. It's time for another deep dive into some seriously important accounting concepts. And I know exams are probably looming, so let's tackle three big ones that always seem to pop up. We're talking uncollectible accounts, notes receivable, and depreciation.
And these aren't just exam favorites. They're like the building blocks for understanding how businesses handle risk and transactions, and making sure those financial statements tell the whole story.
Exactly. They're essential. And if you're looking for that extra edge in your studies, make sure to check out gradeguru.nl. They've got practice exams and a full summary of all these topics. Okay, so let's start with those uncollectible accounts. Why do we even care about them in the first place?
Well, think about it. Ignoring potential bad debts, it's like setting yourself up for a financial disaster later on. Those financial statements, they won't be accurate.
Okay, so ignoring them is a no-go. But what's the big deal if a few customers don't pay up?
Well, imagine you're a business owner. You're looking at your reports and thinking business is booming.
Hmm,
But then what if? What if some of those sales were to customers who just aren't going to pay? Suddenly those numbers aren't so reliable.
right. It's like celebrating a victory before you've actually won.
Yeah.
So how do businesses avoid that?
It's all about being realistic, acknowledging that not every customer is going to pay up. We need to estimate those uncollectible accounts in advance.
Okay, so instead of pretending everything's perfect,
hmm
businesses need a dose of reality. But how do they actually put a number on these potential losses?
There are two main methods, and they each have their own logic. First, we have the percentage and net sales method. It's kind of like looking back at your sales history and saying, okay, based on what's happened before, about 2% of sales usually go unpaid.
So it's a kind of historical average.
Exactly. You apply that percentage to your current net credit sales, and that gives you an estimate for the period.
Got it. Simple and straightforward. What about the other method?
That's called the aging of accounts receivable method. And it's a bit more detailed. It takes into account how long an invoice has been outstanding. Because the longer it's been, the less likely you are to collect.
Right. That makes sense. Like if someone hasn't paid in 3 months, chances of them suddenly coming up with the cash are pretty slim.
Exactly. So with this method, businesses categorize those receivables into different age buckets, like 0 to 30 days, 31 to 60 days, and so on. And they assign a higher estimated percentage of uncollectibles to the older ones.
I see. So it's more nuanced. It factors in the age of those invoices and the likelihood of actually getting paid. So let's say a business has chosen their method. What happens next?
Well, now they need to account for those potential losses. That's where the allowance method comes in. It's like setting up a rainy day fund for bad debts.
Okay, I like that analogy. A little financial cushion.
Exactly. And it involves using something called a contra asset account. It might sound a bit intimidating, but it's really not that complicated.
So instead of just pretending everyone will pay, businesses are being proactive and acknowledging that some receivables might go bad.
Precisely. This way is more transparent and accurate. It's like a built-in reality check on those financial statements. And it also follows that important matching principle.
Ah, yes, the matching principle. I remember that from my accounting class.
It's all about matching expenses to the revenues they relate to. And if you just ignore potential bad debts, well, you're not really matching things up properly.
It's all about showing a true and fair view of how the business is performing. Now, I've also heard of the direct write-off method. How's that different?
That's more like sweeping things under the rug and hoping no one notices. You wait until an account is definitely uncollectible before you recognize the loss.
It sounds a bit risky. Why isn't that the preferred approach?
Well, for one thing, it violates the matching principle. You're not recognizing the expense in the same period as the revenue, and that can really distort your financial statements.
So it's kind of like delaying the inevitable. Okay, back to the allowance method in that rainy day fund. Let's say we've made our estimate and set up our allowance. What happens when we actually have to write off a specific bad debt?
Good news, it doesn't hit the income statement again
Ah,
because we already accounted for it with that allowance we set up.
so it's like we anticipated this.
Exactly. When we write it off, we just reduce the allowance for uncollectible accounts and reduce accounts receivable as well.
So we're just adjusting the books to show that this particular customer won't be paying.
Yeah.
Makes sense. But all this estimating and adjusting, it must have an impact on other financial statements too, right?
Absolutely. It's like a ripple effect.
Mhm.
On the income statement, we've got the uncollectible accounts expense, which reduces net income. And on the balance sheet, we're using that allowance to adjust accounts receivable so it gives a more realistic picture of what we can actually expect to collect.
And what about the cash flow statement?
Well, there's no direct impact there because we're dealing with non-cash transactions.
Okay, so we're recognizing the potential for loss. But the cash flow itself isn't directly affected.
Right. But it's important to remember, even though cash isn't directly impacted, this whole process affects a company's overall financial health, and that can influence their decisions down the line.
All right, so we've covered uncollectible accounts. Now let's move on to something a bit more formal. Notes receivable. These are like those you owe me situations, but with a legal contract involved.
Exactly. Think of a note receivable like a legally binding IOU. It lays out all the terms of a loan, the amount borrowed, the interest rate, the repayment date, everything.
So it's like a step up from a casual agreement.
Right. And to understand these notes, we need to be familiar with a few key terms.
Okay, let's hear them.
Well, first, there's the principal. That's just the original amount of the loan.
Okay, makes sense. What else?
Then you've got the interest rate. That's the percentage charged for borrowing that money, usually expressed annually, kind of like the APR on a credit card.
So a little fee for using someone else's money.
Exactly. And then every loan has a deadline. With notes receivable, that's called the maturity date. The day when the full amount, both principal and interest, is due.
Got it. And how about the duration?
That's just the length of time between when the note is issued and that maturity date.
Okay, so we have the starting point, the ending point, and the time in between.
Right. And at the end of it all, you have the maturity value. That's the total amount due. Principal plus all that accumulated interest.
Okay, it's all starting to come together. But I have to admit, calculating all that interest seems a bit intimidating.
Don't worry. It's not as scary as it sounds. It's just a bit of multiplication. You take the principal, multiply it by the interest rate, and then multiply that by the time period.
Okay, so similar to calculating interest on a savings account, but in this case, we're the ones earning the interest.
Exactly. And speaking of earning interest, let's talk about how all this note activity gets recorded in the books.
All right, because I imagine there are a few different scenarios to consider.
You're right. We have issuing a note, accruing interest, collecting when it matures, even handling those notes that don't get paid.
Okay, let's break it down one by one. First up, issuing a note. What happens when a company decides to lend money this way?
Well, they're basically exchanging something, like inventory they've sold or maybe an existing account receivable for this formal promise to pay.
So they're trading one asset for another.
Right. But now they have a legally binding IOU.
What about accounting for the interest as it builds up?
That's called accruing interest. Even if we haven't received the cash yet, we still need to recognize that income.
Like getting excited about a gift before you've opened it?
Exactly. So we make an adjusting entry. We debit interest receivable, which is an asset because it represents money we're owed. And then we credit interest revenue, which increases our income.
Got it. We're basically saying we've earned this even if we don't have the cash yet. Now let's fast forward to maturity. The borrower pays up in full. How do we record that happy event?
That's the moment we've been waiting for. We debit cash for the full maturity value, which includes both the principal and all that interest. Then we credit notes receivable to reduce it to zero, since the note has been fulfilled. And finally, we credit interest revenue for the total amount earned.
Sounds like a clean and satisfying ending. But what if things don't go as planned? What if the note isn't paid at maturity?
That's called a dishonored note. It doesn't necessarily mean we'll never see the money, but it does mean we need to adjust our records. We debit accounts receivable for the full amount, basically moving it back into our regular receivables. Then we credit notes receivable and interest revenue to reverse those original entries.
So it's like we're going back to square one and trying to collect through regular channels.
Exactly. It's all about keeping those financial statements accurate.
Okay. So where does all this note-related activity show up on those statements?
Well, notes receivable will be on the balance sheet, either as a current asset if it's due within a year, or as a non-current asset if it's longer term. And any interest receivable we've accrued will also be a current asset.
Okay, so that's where we see the value of these notes reflected. What about the interest revenue?
That's recognized gradually over the life of the note, usually as part of other income on the income statement.
So a steady stream of income as that interest builds up. Right, we've covered uncollectible accounts and notes receivable. Now for the final challenge. Depreciation. And just to be clear, we're not talking about that feeling you get when your new car loses value the second you drive it off the lot.
Right. Depreciation in accounting is about systematically spreading out the cost of an asset over its useful life, like buildings, equipment, vehicles. It's like prepaying rent on a piece of equipment. Recognizing the cost gradually as you use it up.
Okay, so it's not about market value declining, but about recognizing the cost of using the asset over time. And this ties back to the matching principle again, right?
Absolutely. We want to match the expense with the revenue it helps generate.
But before we get into how to calculate it, let's define some key terms.
Agreed. These terms are the foundation. First, we have the cost of the asset, that's the original price, plus any costs to get it ready for use.
So like installation or delivery charges.
Exactly. We want to capture the total cost to get it up and running.
What about the value at the end of its useful life?
That's the residual value, sometimes called salvage value. It's our best guess of what it will be worth when we're done using it.
So if we were buying a truck, the residual value would be what we think we could sell it for after, say, 5 years.
Precisely. And if you take the original cost and subtract that residual value, you get the depreciable cost. That's the portion we're actually going to depreciate.
Okay. And how do we determine the time frame for that?
That's the useful life, an estimate of how long it'll be helpful to the business.
So a delivery truck might have a useful life of 5 years, but a specialized piece of equipment could be 10 years or more.
Exactly. It depends on wear and tear, obsolescence, company policies, and then we have carrying value. That's a snapshot of what the asset is worth on the balance sheet. It's the original cost minus all the accumulated depreciation up to that point.
So accumulated depreciation is a running total of how much we've depreciated so far.
You got it.
Okay, I think we've got our vocabulary down. Now let's talk about the different ways to actually calculate this expense.
Sounds good. Because accounting always likes to give us options.
Right. It's never one size fits all. So what's the first method we should know?
The straight line method. It's the simplest and most common. You just divide the depreciable cost by the useful life. And that gives you the annual depreciation expense.
So if we have a $10,000 piece of equipment with a 5-year useful life, the annual expense would be $2,000.
Exactly. Nice and even.
But sometimes we might need something a bit more
Exciting.
What about the double declining balance method?
Ah, yes. That's an accelerated method. It front loads the depreciation. More expense in the early years, less in the later years.
Interesting. So instead of a steady pace, we get a burst of speed at the beginning. Why would a company choose that?
Well, some assets, like vehicles, lose value quickly at first. So this method might reflect that better. And sometimes there are tax benefits to bigger expenses early on. But remember, we're not tax experts. Always consult a professional for that.
Good point. So how do we calculate this front-loaded depreciation?
You start by calculating the straight line rate, which is just 1 divided by the useful life. Then you double that rate. And to get the expense for a specific year, you multiply that doubled rate by the book value at the beginning of the year.
Okay. A bit more complex, but it makes sense. What about that third method, the one that's based on actual usage?
That's the units of production method. It ties depreciation directly to how much you're using the asset.
So like paying per mile for a rental car.
Exactly. The more you use it, the more it costs.
Makes sense. So how do we figure out the expense with this method?
Well, we have to track the actual usage to get the depreciation rate per unit. We divide the depreciable cost by the total estimated usage over the asset's life.
So for a truck, we divide by the total miles we expect to drive it.
Precisely. Then we multiply that rate by the actual usage in a given period.
So if our truck drives 20,000 miles in a year, we'd multiply that by the rate per mile to get the depreciation expense for the year. It seems very directly tied to the revenue the asset is helping to generate.
Exactly. It's all about matching.
All right, so we've got our calculation methods. Now, how do we actually record depreciation in the books? What are the journal entries?
The good news is it's the same entry for all 3 methods. We debit depreciation expense, and we credit accumulated depreciation.
Wait a minute, accumulated depreciation, that sounds familiar.
It's a contra asset account, just like the allowance for uncollectible accounts.
So it's like a sidekick to our asset account, keeping track of all the depreciation we've recorded.
Exactly. And we make this entry regularly, each period throughout the asset's useful life.
Like a depreciation ritual.
You could say that.
And, of course, this affects our financial statements. On the income statement, depreciation expense reduces our net income.
Right. And on the balance sheet, accumulated depreciation reduces the carrying value of our assets.
Okay, so we're constantly updating that carrying value to reflect how much the asset's cost is still undepreciated.
Exactly. It's a dynamic process.
But what happens when we decide to get rid of an asset? We've depreciated it over its useful life. But what about when we sell it or trade it in?
Great question. When we sell an asset, we need to figure out if we made or lost money on the sale.
Okay, so how do we do that?
We compare the selling price to its carrying value.
So what the market is willing to pay
Yeah,
versus what our books say it's worth.
exactly.
Yeah.
If the selling price is higher, we have a gain on the sale. If it's lower, we have a loss.
Like selling something for more or less than you expected.
Exactly.
Wow, that was a lot of information about depreciation.
We covered a lot. calculating it, recording it, even what happens when you sell the asset.
And just like with uncollectible accounts and notes receivable, these aren't just abstract ideas.
They're real-world tools that businesses use every day to track costs, make decisions, and paint an accurate picture of their financial health.
I'm definitely feeling more confident about these concepts now.
That's great to hear. And remember, gradeguru.nl has even more resources to help you master these topics.
It's like having a personal accounting tutor. Now, before we wrap up this part of our deep dive, I have a little challenge for our listener.
Oh, I love a good challenge. What is it?
We've talked about how businesses choose a depreciation method. I want you to apply that knowledge. Think about a business you know, maybe a local store, a car dealership, or even a tech company.
Okay, I'm picturing that bookstore I mentioned earlier.
Perfect. Now put on your accounting hats. What depreciation method do you think they might use for their different assets, and why? What factors might they consider?
That's a great way to connect the dots between the textbook and the real world.
Exactly. It's all about seeing how these concepts play out in practice. And remember, if you get stuck, gradeguru.nl is there to help. All right, everyone, that's it for this part of our deep dive. We've covered a lot of ground today, but hopefully you're walking away with a deeper understanding of these essential concepts.
And feeling more prepared to tackle them, both on your exams and in your future careers.
We'll catch you in part 2 to continue our exploration of the fascinating world of accounting.
See you then.
All right, everyone, welcome back to our deep dive into some seriously important accounting concepts. We're picking up where we left off, talking about depreciation, and specifically, what happens when a company decides to say goodbye to an asset. We've covered how they depreciate it over its useful life, but what about when they sell it or trade it in?
Well, when a company decides to dispose of an asset, they can't just forget about it on their books. They need to figure out if they made or lost money on the sale.
Okay, so it's like checking if they got a good deal or not.
Exactly. It's all about comparing the selling price to what's known as the asset's carrying value.
Carrying value. Remind me what that is again.
Right. So the carrying value, it's basically what the asset is currently worth, according to the company's books. It's the original cost minus all the accumulated depreciation.
So it's like a snapshot of the asset's remaining value after all that depreciation.
Exactly. So when we sell an asset, we compare that selling price to its carrying value.
Okay, so we're looking at what the market is willing to pay versus what our accounting records say about its remaining value.
Right. And if the selling price is higher than the carrying value, that means the company made a profit on the sale. We call that a gain on disposal.
Okay, a little bonus in the books. But what if the selling price is lower? Does that mean they messed up somewhere?
Not necessarily. It just means they experienced a loss on the sale. They didn't recoup their full investment.
Makes sense. It's like selling something for less than you hoped.
Exactly. It's all part of the business cycle. Sometimes you win, sometimes you lose.
Well, hopefully those gains outweigh the losses in the long run. All right, so we've covered how companies account for those gains and losses when they dispose of an asset. Now let's zoom out a bit and talk about the bigger picture. Why are these concepts of uncollectible accounts, notes receivable, and depreciation so important for understanding a company's financial health?
Well, these concepts are all about managing risk and presenting a realistic view of a company's financial position. Uncollectible accounts. They force businesses to acknowledge that not everyone will pay their bills. It's about being proactive and setting aside funds to cover those potential losses.
So it's like building a safety net.
Exactly. And notes receivable. They help businesses track those more formal loans, ensuring they account for both the principal and the interest they're owed.
Okay, so it's about keeping tabs on those legally binding IOUs.
Precisely. And then there's depreciation. It's all about recognizing that those long-lived assets, like buildings and equipment, they don't last forever. They wear out, become obsolete, and eventually need to be replaced.
So depreciation helps companies spread out the cost of those assets over their useful lives.
Exactly. It's about matching the expense of using the asset with the revenue it helps to generate.
I see. So these concepts all tie back to that matching principle we talked about earlier.
Absolutely. And by understanding these concepts, investors, creditors, and even the companies themselves can get a much clearer picture of a company's true financial performance.
Like removing those rose-colored glasses and seeing the reality of the situation.
Precisely. And speaking of seeing the reality, I think it's time for another one of your real-world challenges.
Oh, you know me so well. All right, everyone. Think back to that business we talked about earlier, the one you're familiar with. Now put on your accounting hats again and think about all the decisions that business has to make. decisions about managing their cash flow, investing in new assets, and even planning for the future. How do you think these concepts we've been discussing, how do they influence those decisions?
Ooh, that's a great one. It really makes you think about how these accounting concepts, they aren't just numbers on a page, they have a real impact on how businesses operate.
Exactly. And they're essential for anyone who wants to understand how the financial world really works. Whether you're running a business, investing in the stock market, or even just managing your own personal finances.
And speaking of getting a handle on these concepts, don't forget that gradeguru.nl has a wealth of resources to help.
They've got practice exams, detailed summaries, even audio lessons to guide you through all the trickiest topics. It's like having a personal accounting tutor in your pocket.
Exactly. So if you're feeling a bit lost or just want to make sure you're on the right track, be sure to check them out.
All right, everyone. That's it for part 2 of our deep dive. We've covered a lot of ground today, but hopefully you're walking away with a deeper understanding of how these accounting concepts play out in the real world.
And feeling more prepared to tackle those upcoming exams.
We'll catch you in part 3 to wrap up our exploration.
See you then.
Welcome back, everyone, to our deep dive. We've been tackling some pretty heavy accounting concepts: uncollectible accounts, notes receivable, and depreciation. But I hope you're starting to see that these aren't just abstract ideas.
Right. They're the tools that businesses use every day to make sense of their finances and make those crucial decisions.
Exactly. And by understanding these concepts, you're not just preparing for exams, you're gaining valuable insights into how the financial world works.
Whether you're running a business, investing, or even just managing your own money.
These concepts are essential. So let's do a quick recap. Make sure we've hit all the key points. First up, we talked about uncollectible accounts, those pesky customers who just don't pay up.
Right. We talked about the importance of estimating those potential losses and the two main methods, percentage of net sales and aging of accounts receivable.
And we dove into the allowance method, that rainy day fund for bad debts.
Which is a much better approach than just sweeping those losses under the rug.
Agreed. We want those financial statements to be accurate and transparent. Then we moved on to notes receivable, those formal, legally binding IOUs.
We broke down all the key terms, principal, interest rate, maturity date, and talked about how to calculate that all-important interest.
And we walked through all the different scenarios: issuing a note, accruing interest, collecting at maturity.
Even dealing with those dishonored notes.
It's like a whole financial roadmap.
Oh.
And finally, we tackled depreciation, that systematic way of spreading out the cost of a long-lived asset over its useful life.
We covered the key terms: cost, residual value, depreciable cost, useful life, and carrying value, and explored those three main depreciation methods: straight line, double declining balance, and units of production.
Each with its own logic and advantages. And of course, we talked about how all of these activities impact those crucial financial statements.
The income statement, balance sheet, and even the cash flow statement.
It's all interconnected. So remember, everyone, these concepts aren't just about passing exams. They're about understanding the language of business and using that knowledge to make smart decisions, whether you're analyzing a company's performance or managing your own financial future.
And if you're looking for extra help mastering these topics, don't forget about gradeguru.nl. They've got everything you need to ace those exams and build a solid foundation for your accounting career.
It's like having a personal accounting tutor available 24/7. Okay, everyone, that wraps up our deep dive into uncollectible accounts, notes receivable, and depreciation. We've covered a lot of ground, but hopefully you're walking away feeling more confident and prepared. Thanks for joining us. We'll catch you next time for another exciting accounting adventure.
See you then.